It's a new year, 2026, and most of us want to do two things to begin the new year. We want to hit the gym harder, we want to be physically fit and healthy. And if you like myself, number two is you want to manage your money better. So you came to the right place. I'm going to give you five simple, easy steps to follow, and you're going to be able to manage your own portfolio. Okay. If you listen to the people on TV, they'll probably tell you, put your money in a mutual fund or an ETF like that follows the S&P 500 like VOO or the entire stock market like VTI. And sure, you can get safe returns and it's pretty easy. You kind of set and forget it. Some of you might want to put in a large sum of money at once and just wash your hands and just watch it build. Or some of you might like to do dollar cost averaging, and that's simply just putting a little bit of money in every month around the same time every month, and then you'll get an average um, cost over the long term, and you don't have to really wait for dips or wait for a good buying opportunity to put in a large amount of money and for it to take off, much like the market did in April of 2025 when Trump introduced the tariffs and the market tanked, which was actually on my birthday, was actually the lowest point of the market. And then from there, the market really just took off when we had a profitable year. The S&P 500 returned around, I think it was like 17 or 18% in 2025. Well, by following these easy five steps that I'm going to outline and break down to you guys, I was able to double the S&P 500's return and almost hit 40%. I think we hit around 39.93%. And I'll show you that here in just a moment. I am not a professional, and this is by no means financial advice. I'm just here to simply share how I've successfully managed the market, was able to pick individual stocks successfully and ride those stocks throughout the year to had substantial returns that actually beat the S&P 500's return. Okay? So let's get right to it. But first, if you really want to dive in with me, I have a free Patreon. The link is available in the description or on the homepage of our All in Society page. And if you really want to get busy with us, it's only $10 per month. You can see all of my stock picks, all of my moves in real time. We do long-term investing like we're discussing now, and then we also do options trading. So if that interests you, it's only $10 per month. I think it's a great price, a lot of value. I'm consistently posting on there, and we have a small but fun community of folks that are really taking this serious. So I'd love for you to join. But let's not wait anymore. Let's get right to it. I'm going to share my screen, put my little bubble here, and I just want to show you guys. So this was last year. So the S&P 500, like I said, had a return of about 18% in 2025, and I think you should be able to see it. Trying to move it over. It's being difficult. But we yielded just under 40%, 39.93%, like I said. Okay. And if you're someone who's interested in options trading, we had a nice year. We had realized profit of just under 33,000 in options. Okay. And we're going to strive to do better than we did last year. I'm hoping for like a 50% return from the long-term investing, and I'm hoping to have about $50,000 of realized gains in 2026. But we got to put in the work first. So here we go. So the first thing I want you guys to do is, now I build this all out and I have a iPhone, so I use notes. You can write it down. Maybe you could do a spreadsheet in Excel if that's something that works for you, if you enjoy Excel. But the first thing I need you to do is have a game plan and write it down. Okay? Couple steps I need you to do before you get started. And you don't have to have all your funds at once, but have a ballpark idea and have a portfolio. Excuse me. Go to a brokerage and open an account, individual investing account, and make sure that account is funded. All right. You can start with $500, start with $1,000. You can gradually add on to it every month. And so you're able to invest more as the year goes on, or you just put a lump sum of cash down all at once. So last year I started with around 2,500 or so. This year I'm going to start with um, around $3,000, $4,000, and then we'll add on to it throughout the year. Whatever you are comfortable with. You don't have to start with 3,000. You can start with 500. Ideally, I would say at least $1,000 to start. But if you don't have it, you just be patient and you just follow these steps, and you'll be able to execute just as well as somebody that has a ton of money to invest. You might just shrink how many individual stocks that you're going to invest in. Or if you're someone who likes ETFs, you can have a portion of that account in ETFs, and you can start that from the beginning. And then as the year goes on, you can see how the market is moving, and then you can start dabbling in individual stocks if you choose. But first and foremost, fund that account, and we're going to give ourselves a ballpark idea of what we're going to working capital we're going to have to start. Okay. Then you want to pick no more than 5 companies and maybe even a commodity in there as well that you're going to invest in. We're going to keep this small. We don't have to have a large portfolio investing in 10 to 20 different things. We want to pick our best ideas, do research on them, our highest conviction plays. The companies are fundamentally sound and have great growth opportunities for not just 2026, but for years ahead. So what I've done with this account, I tear it down at the end of the year. I sell off a couple things and keep the cash, and some of the assets that I want to keep for the long term, I move them into another account. Okay. So that's what we did. We yielded the 40% or just under 40% last year. We sold some things, kept the cash, and then we moved them to another account. All right. Now, if you have no idea what you want to invest in or even how to pick individual stocks, there's a couple things that I want you to do. Because the last thing I want you to do is just listen to what I have to say. First and foremost, I am not a professional. I don't have a degree in finance. I'm just someone who's gone to multiple conferences and read a ton of books and really created a strategy that works for me. My background is in the casino industry, specifically in poker. So I kind of mirrored a lot of my poker strategy and mindset to the stock market. That may not necessarily work for you. So with that being said, I need you to go on YouTube, find some folks that you relate to and that are be able to teach you the market as well. Branch out, diversify, and we'll talk about that just in a second in our investing picks. But one book that I have enjoyed, it's a new book. If you're a fan of Jim Cramer, it's How to Make Money in Any Market. I highly suggest you guys pick up that book and read that book. A lot of the things that I kind of hold my hat on, Jim Cramer is reiterating as well. And he does have the background in finance. He has managed a ton of money, millions of dollars. And he's someone that you can follow online and listen to what he has to say. And if you like his insights, you can also join the investing club on CNBC with him as well. Now, I am by no means getting paid for that information. I'm not even in the group myself, but he does have valuable information, and he is a great go-to person for if you're just starting out and want to invest in the market and have no idea how to do it. But a lot of it is based on fundamental investing, and that's what I'll hold my hat on. In 2025, that's all I really focused on till the latter part of the year. Then I started getting into technicals and reading the charts and understanding the charts. And that has really encompassed my strategy to be more wholesome and to understand both sides of the equation, not just the fundamental investing and picking the stocks, but also understanding the charts and how they move. And that's allowed me to understand when to buy and when to take profits and to sell. Still I'm learning, and just recently, yesterday, I learned something new, um, which would have been definitely beneficial if I had known that information before. So this is a game that's always evolving. There's always something new. There's so much information to learn and understand in the stock market. So this is much like poker. It's an easy game to learn, really, when you take the time and dedicate yourself to it, but it takes a lifetime to master. So those one of the similarities to poker in the stock market that I was relating to. There's plenty of other people that you can read about. Definitely study Warren Buffett, especially now that he's retired and he's left Berkshire Hathaway. He is a great man, one of the greatest investors ever, and I stand by his mantra of be greedy when others are fearful. And you want to invest in sound companies, great companies, and buy them at discounted prices rather than buying so companies at what you deem as discounted prices or cheap prices. A lot of us are going to run to penny stocks and cheap stocks and hope that they take off. No, that's really not the strategy that I believe is successful over the long term. You want to look for those companies that have higher valuations than like a penny stock, because they have a higher valuation most of the time for a reason. Okay, penny stocks are penny stocks for a reason. Most of the times, those companies that are not profitable. We invest in profitable companies with sound balance sheets, who have great management, and they have consistency. Okay, so let's really get down to it. And number one is building out that portfolio. So we talked about picking individual stocks. We talked about having starting capital and knowing what we're going to work with. And now we're going to write it down. Okay, so you see here, I have the 2026 portfolio. I have the amount of capital I'm starting with up top here. I have the date, January 1st, 2026. And then you see here, I have it broken down. All right. So to make this easy, you don't have to follow these percentages, but your percentages want to equal to 100%. Okay. So stock one, I'm going to put 25% of that $3,098 into stock one. Okay. Stock two, I'm going to put 20% of the $3,098 into stock two, and then so on and so forth. And then down here, you see it says 20% in cash. Now, this part is extremely important, and we'll talk about that in another rule, but you always want to have cash on hand. There's always going to be times when the market is going to dip. Historically, every year we get about a 5 to 10% dip. And when that opportunity comes, a lot of times those dips get bought back up, and that's a buying opportunity. It may not necessarily hit your stocks that you're invested in. It might be an overall market, but there's usually opportunity when those red days and those, or that month, or however long it lasts. There's usually opportunity for you to put some money to work there and reap the benefits in the future. So to make it simple, your first year you could just do 4 stocks in cash, and all of them have 20%. So they all are equally weighted. You have 20% in cash, and you have 20% in one, 20% in three, 20% in stock two, and then 20% in stock one. And it's all even. And then it's very easy to manage. You don't really have to look back at this too much. You know, everything's supposed to be allocated at 20% of your portfolio. If you're fully invested in stock one, say it's Apple, you have your full position throughout the year. You've been buying slowly, and the market falls, right? And that 20% drops down to 15 or 10%. You want to do your research, see if anything changed, the reason why, your thesis of why you bought that company. If nothing changed, and it's just the entire market is just on a downturn at that time, there might be an opportunity for you to buy more. So you go into your cash at that point and you buy more shares to bring it back up to your 20%. Okay? So that's why it's important to have your cash on hand. As well as when you write this all down and we'll go back to our Apple example, you have your full allocation, it's 20% of your portfolio. But as the year goes on, that 20% runs to 25 or 30%. Then you can start nibbling off of that, right? Because you want to keep our portfolio balanced. You can start nibbling off the top, right? If you have multiple shares, nibbling off the top if you want to, and taking some profits and putting that into your cash and waiting for another buying opportunity. Maybe one of your other stocks, it dips because it has an earnings report and the earnings report has a negative reaction. But as you do your research and understand the earnings report, the company says things are fine. It was just a rough quarter. They're still going to keep their guidance for the full year. It was just, like I said, it was just a bump in the road. That might be an opportunity to add on to that stock. So that's how we're going to manage that portfolio. So, like I said, it's very important that we have our starting capital. We write this down. We know how everything's supposed to be allocated. We're picking the best stocks. And one thing I want to add to this, you want to have a diversified portfolio. So if you stock one is Apple, the last thing I want you to have is a bunch of tech companies. Because if the entire tech sector decides to fall and that goes out of fashion, for lack of a better word, that could weigh on your entire portfolio. Whereas if you had an Apple and you had something in communication services, maybe you had a financial company, and then you have some type of, I don't know, a defensive company, something like that, or a consumer discretionary. You want it to be diversified. You don't want to have all your eggs in one basket, one sector, one industry. So be mindful of that as well. And don't worry, I'm going to show you a tool to kind of help you identify some of the different sectors that you can take a look at, and maybe it'll help you find other companies that you're familiar with to invest in. Last thing on this, as far as picking stocks, you want to invest in what you know and what you understand. So for me, I love a company like DraftKings because I understand that business more so than your average person. And honestly, with my research and understanding, I think I understand the company and how it operates better than some of these analysts do. So that is a company that I keep an eye on and I'm actually invested in. Or say like a Caesars or a MGM or a Penn Gaming, companies in the entertainment business. Okay, those are the companies that I like. But also you want to be mindful that tech companies are those high growth companies. Last thing I want you to do is investing in companies that are not going anywhere. Okay, there you can look at the charts. You can go to Yahoo Finance or whatever you want to look at to identify and do a little research on the companies you're willing to invest in. Look how they performed over the past 5 years. I like a company over 5 years, their percentage return is 100% or more. If it's not 100% or more in the past 5 years, I'm really not looking at it. But also be mindful that past performance is not indicative to future results. Just because a company hasn't performed well the past 5 years doesn't mean that it's not going to perform well in 2026 or beyond. So just use that as a caveat. Not use that just by something that you have to live by. You're going to live and fall on that sword. Okay, it's just something to keep in the back of your mind. All right, we're going to go down. Rule number 2 is never buy your full position all at once. Okay? And you might ask now, Cloud, what do you mean by that? Well, that simply means, say, we'll go back up here and stock 1, say that's Apple. And January 5th, right? You want to, all right, Claude, I've wrote everything down. I know I want to invest in Apple. I've done research. I have conviction in this company. I have $1,000 I'm going to invest in this company. I'm going to leave 20% in cash and I'm going to put the rest of the 800 in Apple. I'm going all in Apple and I'm buying my full allocation of 20%. Well, no, that's not what I want you to do at all. And the reason for that is because you're not giving yourself any type of wiggle room. What if the stock falls? So you have an earnings report coming up. What if the earnings report isn't as perceived very well and the stock decides to fall? So you want to buy your you want to put you want to buy it in kind of like sections and allocate it out slowly but surely. So say if you're going to invest $1,000 in one company, right? Maybe you break it up and I'm going to put 250 in now and wait for the earnings report. I'll put another 250 in then. And then if throughout the year, maybe you get some dips because the market is going to have variance. It's going to go up and going down. It might be a buying opportunity. You buy your last leg then. Okay, so you want to buy in stages. You don't want to put it all at once because you're excited in this company. Now, if you did your research and it's saying that this is a great price, the earnings report's coming up, and there's a lot of information that's coming out, and you have strong conviction this is going to be a blowout quarter and you want to get invested, maybe you put in 50%, half of your cash that you're allocated towards that asset, and be a little bit more aggressive. But last thing I want you to do is put everything all in at once. And I just did an example of buying Meta shares. Meta shares are sitting at 650. Okay. So just be mindful because Meta is out of favor right now. If next quarter they report and things haven't necessarily changed, the shares could fall. And if you buy put all your cash towards that asset all at once, and you don't have any cash left over to buy a dip, you might just be sitting on that for the rest of the year and not being able to take advantage. If there's a great quarter and the shares decide to take off, or it dips maybe just like 5%, and you want to add on because it dipped 5%. So just be mindful of that. Don't buy all your positions at once. I know this is one thing that I am terrible at. Be mindful of your cash positions and always keep reserves on the side. I'm terrible at following this rule. Now, I won't necessarily buy everything all at once, but if it's like a strong quarter and see things are going to go well for X company in the future and they kind of got past their rocky road period, I'll start aggressively going in and I'll start to deplete my cash. And when there's opportunity in the market dips, I only have, say, like 10%, and I really can't take advantage of that. So it's very, very, very important. Try your best to keep that 20% cash in there at all times. Just kind of don't even just leave it in there and just act like it's not there. Those are your emergency funds. Say your car breaks down or whatever the case may be. You have a medical bill, the unexpected medical bill. That's what we're using that account for. Just those unseen scenarios. But in this case, the market is always going to give you some type of small correction that you're going to be able to take advantage of. We definitely saw it 2025. And when the information that came out early this morning about the Trump administration attacking Venezuela and basically taking the president out of there, and I think his wife as well, and they're going to run Venezuela until they have someone else in power. Those things like that are going to shake the market. Now, I can't predict how it's going to shake the market come Monday, but more than likely there's going to be some type of impact to the stock market to that information. And I'm going to give you one thing that we are buying Monday is gold. In certain times, in times of geopolitical tension, gold is a safe haven space for people to put their cash. And so if investors or people are feeling nervous because of what's going on here and this attack, then gold is likely to move higher. So that is one thing that I'm definitely going to be looking at come Monday. So make sure you write that down. That's the tip of the weekend for you. So that's why it's very important. Now, I'm not really someone that follows politics a lot, but I want to understand what's going on and how that may impact the market and how I could potentially take advantage of that. But to get back to it, again, rule number 3, be mindful of your cash position and always keep cash reserves. Number 4, keep your emotions in check. Trust your research. Stay the course. This is extremely difficult, but this game is for the patient man or woman, And this is not a game for you to keep your emotions running amok. You want, just like playing poker, you're going to win hands, you're going to lose hands. There's going to be hands where you have pocket aces and you lose to a hand like 3-5 offsuit. And it can really like piss you off and make you angry. Just the bad luck that you have such a strong hand and you can still lose. Now, the good thing about the stock market, there's not really any luck. Now, you can be lucky you're born or you start investing in X time, or if you're watching TV and you hear someone talk about Nvidia like 5 years ago and you bought a ton of shares in Nvidia. Now that in that aspect, I guess it could be luck. Or if you're on a subway and you hear some businessman talking about some type of company, some information that's not publicly available, and you're able to take advantage of that, that could be luck. But things like that are opportunities. And the good thing about the stock market, unlike poker, you invest and you stay the course over the long term, you're more than likely to succeed as long as you hold your assets rather than trading in and out. I'm not a day trader. I don't try to be. When I have tried, I haven't been successful at it. But I know if you buy and you hold your assets over a long period of time, you're going to be able to, as long as you're buying sound companies and great companies and keeping up with the research, understanding what's going on in that company, you more times than not, you're going to be able to come out ahead. And while that being said, you have to be able to go with the ebbs and flows of how the stock market moves. Sometimes there can be things that are completely unexpected and they rock your portfolio. Again, do your research. If the reason why you bought the company, nothing fundamentally has changed, you need to identify, is it time for you to sit on your hands and wait this out, or take it as a buying opportunity and use some of that cash you have on the side and put it to work. Okay, so a great example of this is like we talked about at the beginning of this video. In April, when the stock market tanked because I think, what was it, Insurrection Day, and Trump, I probably butchered that. I don't think that's what the name of it was. But Trump decided to put in the tariffs in April and it crushed the stock market. Now, if you're someone like folks that I've, talked to around that time, they're saying, I'm taking all my money out of the stock market. I'm not dealing with Trump, la-di-di, la-di-da. Then more than likely you missed out on those substantial returns if you just would have held steady and held on to your best assets. Now, don't get me wrong. At that time, I sold out some of the companies that I was in. Unfortunately, at the time, Google wasn't doing very well even before then. So I said, I'm going to get out of Google and I'm going to buy more shares of the other companies that I had more conviction in. Now, that didn't pan out very well for me because Google had an excellent second half of the year. But the other companies that I invested in, they took off and I was able to have substantial returns with them. And I guarantee if I just would have sold everything and tried to jump back in, I would have got back in at probably the wrong time and wouldn't have the opportunity to ride that complete ride up. I probably would have got in like halfway through, and that still would have been successful at that as well. But I had a much better return compared to the overall market because I stayed invested, understood this is a long game, remain patient, don't panic. I didn't hear Warren Buffett panicking. Now he's on another level, so it's kind of hard to compare ourselves to him. But if someone's like, some folks of that nature are not panicking and not saying sell everything that you have, then you gotta just have to kind of eat some of it, right? Eat it, allow the time to go through. Maybe just don't check your portfolio as often as you probably were before that time that we had to go through with the tariffs and everything. And then more times than not, we're going to come out ahead by not being emotional, not selling everything because we see our companies that we're invested in decide to go on a decline for a short period of time. We were still in a bull market for the most part. Yes, there was a lot of uncertainty with the tariffs, But if you stayed through with some of the companies that like weren't really necessarily going to be affected by tariffs, say like a Netflix, right? Um, More people are going to keep their Netflix accounts rather than sell off because of the tariff situation. Tariffs didn't necessarily really impact Netflix and their subscribers and its company as a whole. Now, today, because they are trying to purchase Warner Brothers Studios, the stock isn't doing very well. But during April and earlier part of 2025, that was a good place to kind of put your money and just sit back and wait until things turn around, for example. So, again, stay the course, invest in the fundamentally sound companies. Those companies were going to be the ones that would be able to maneuver through the tariff volatility. Stay patient, have conviction in your best plays, don't panic, buy the dip if you saw it as a buying opportunity, or just sit in your hands and wait for things to turn around. And then the last point I wanted to share with you guys, and this is important. A lot of folks probably don't talk about this too much, but be mindful when you're buying shares of something, buy it in a limit order rather than a market order. So a limit order, you can essentially determine what you're willing to pay for that asset. Whereas if you put it in a market order, you're just going to pay whatever the market deems that asset's value is at that time. And there could be a lot of volatility at the time, and you can pay a lot more for an asset that you wanted to originally. So always put in limit orders, place the amount that you're willing to pay for that asset, and just let it come to you and be patient about it, okay? That's pretty simple. Limit orders over market orders. All right, I just want to end with a couple of tools for you guys to check out. One is barchart.com, and it basically is, and we'll just go to there. It's a great way to do some research on companies. So up top here, I just put an apple in the symbol, and you can look and get all this information here. It gives you an overview of the company, explains what the company does, who are the CEOs, all of their financials and things. There's some of the pages that I like to look the most and use the most is down on the left where it says analysts and the analyst ratings. And that'll kind of tell you, all right, the high on the high end, analysts believe over pretty much like a 12-month period, the Apple shares to get up to $350. The lowest target is $230. It tells you Apple is currently trading at $271. And then it gives you the mean target, about $290, where I think Apple shares will probably be over a 12-month period. And it kind of gives you the ratings. Everyone says it's a moderate buy. I like to look for companies that says strong buy rather than moderate buy. And then a lot of information here. It gives you can look at the earnings estimates. You can look at the financial summaries. So it has a lot of relevant information that is on there. If you have a brokerage that doesn't really break down and give you that from all the information. Another is finviz.com. So I like to look at the screener, or excuse me, we go to maps up top here. And this basically tells you how the market is performing on X time period. So if we want to look over, let's just say year to date, we have what, 1 day, 2 days, so much so far in the stock market. You can see how all the companies in the S&P 500 are performing. The lighter the green, that means they are up 3% plus. And if they're red and deep red, that means they're down 3% or more. You can go look at the S&P 500, the Dow, the Nasdaq, the Russell. You can look at all stocks. You can look at ETFs. You can see crypto. This is a great tool to use, and this is really the tool I was telling you guys about as far as finding companies and making sure your portfolio is diversified. Okay. So it gives you have technology, consumer cyclical, consumer defensive, industrials, communication services, financials, healthcare, so on and so forth. And you can look and see, all right, over the past 3 months, which companies have performed the best. And say you want to find something out of technology, well, look down here. Financials are doing pretty good. Oh, look at this. Healthcare is doing pretty good. And there's some companies in industrials are doing pretty good. And this right here can help you find some of the fundamentally strong companies. You still want to do your research because this isn't going to give you everything. There's just telling you how they're performing. Still definitely want to do your research and understand what makes a company fundamentally sound. And then last, this is the fear and greed index. This just tells you kind of like the market sentiment, how the market is feeling about how investors are feeling about the stock market at the time. So past like 3 months or so has been in extreme fear and fear territory, and now we're heading back to neutral. It was in greed maybe about 2 or 3 weeks ago, and that was good to see. I haven't seen greed in a while, so it's just something to give you a glance of how investors are feeling. What's the market sentiment like? And just be remember the mantra quote from Warren Buffett: "Be greedy when others are fearful." So when you're in this extreme fear and it's down here like it was a month ago in 23, that might be an opportunity for you to start buying and find some assets that you had on your watch list and you've been waiting to jump into or add to your portfolio. So that's pretty much all the tools. And the last note I wanted to leave: start using AI tools for research. So your Gemini, your Chat GPTs, your Claude Anthropic, uh, use those for research as well. If you're not someone who likes using going to bar chart or these other tools that I've suggested to you guys, I actually consistently on Gemini. I've been using Gemini more so than Chat GPT, and created like a daily checklist of some of the companies that I have been looking at consistently. And it kind of gives me, and this is really for options trading, but I've created basically, I'm not somebody who likes to look at the charts and understand patterns and stuff. So I basically told it to identify momentum and look for signals to show me that, all right, this company is, it's a great time to jump into options because it has momentum heading its way. And so some of the companies here now, I'm not going to leave that too long, but those are some of the companies that I'm looking at. So definitely tap in with us, guys. I would love to have you in the Patreon. You can join for free, or you can join the paid version. It is only $10 per month. Again, this is not financial advice. I'm just sharing and trying to entertain you guys and inform you of my strategies that have made me a lot of money in the stock market. And I just want to share that information with all of you so we can invest together, we can travel together, and we can live freely. Have our money work for us and not always working for money. All right. Make sure you have a wonderful weekend. Be safe out there, and I'll see you on the next one.